Hey, what is up, dudes and dudettes? This is Due-Diligence here. And in this video, I'm going to teach you a very simple method of selling put for revenue or for income week by week. And you guys are like, but the market is going down. So what? Market crash, so what? There's still a lot of mispricing. There's still a lot of market volatility situations that you can actually benefit from. And let me just show you. Here are some trades that I get from on two of our accounts, and I blur out some other information that you may or may not want to know. And then because we usually do multi-leg option strategies in here, I'm just gonna simple it down for you guys, and you guys can actually make about 1 to 2% consistent return on the last day of the week, actually on the last 2 days of the week, sort of consistently with just selling puts options if we anticipate that the market is going to be really volatile. So in reality, when the volatility is actually really high, if we can make a rational probability decision in terms of where do we think the stock will be in just 1 day, right? What is the probability? What are some high probability event that we know that's going to happen, and sort of bet on that, and it will make consistent 1 to 2% return every single Thursday to Friday. So that actually compounds. So I will show you guys the math. If ideally speaking, if every single trade that we make actually works out, the compounding is actually insane. All right, let's get into it. Alright guys, so the basic principle of this is actually extremely simple. When there is huge volatility in the market, in the options market, you will see a huge fluctuation of options price get increase over a very short period of time. Like for example, when you have this is VIX during a financial crisis, when there's a lot of uncertainty, you see this zigzag, and we see a lot of VIX movement, which is volatility movement going up and down and up and down. And then when volatility movement happens like this, you will see option chain movement moves extremely volatile, like what we're seeing right here. So this is the GME option for on Friday, May 20th, 2022. You can see that when it started trading. So if you start selling calls right on the day of expiration, you actually can do that when you are when you're doing it on Robinhood. This is why I will say that Robinhood can be traders heaven or traders hell. For those of you who are really beginner traders, Robinhood gives you a lot of technically free leverage to trade because they gamify the entire buying and selling process, and they gamify the option process. And then you sort of have free leverage in terms of liquidity. If you guys want me to make a video on why Robinhood is actually really great, if you know what you're doing, I will make a video. Comment down below. So essentially how that works is if you enable the 1 day trading, if you have GME shares, if you have 100 shares of GME shares, you can sell call options at the strike of $90 and collect a premium about $1,000 in the beginning of when market started trading around 6:30 in the AM if you're on the West Coast, and 9:30 in the PM in the East Coast. And then by the time when the market closes, and then for example, if GME doesn't reach the strike price of $90, then this entire option will just expire worthless. That means you only basically you're collateralizing that 100 shares of your GME shares to get $1,000 of instant profit in just 1 day. And if you don't own GME shares, what you can do is you can put out the equivalent of $9,000 and to gain about $100 worth of premium, basically every single Friday due to market volatility. So essentially, how does this work? Why does this work? Or what are some steps that you can do to do this? So basically, we're profiting off of people's fear, or we're profiting off of the innate volatility within retail's let's just say retail's, it's not really like, so retail investors have this ability or this inclination to fire sell or fire buy when a lot of people are selling or buying. And then you see this huge volatile movement. This is GME's just 1 day's volatile movement. And this 1 day volatile movement can go up and down to upswing of 8% to downswing of 8%, which created a 16% volatility range for us to trade. And then essentially how it works is whenever volatility increases, no matter whether you're selling a call option or selling a put option, the option price or the option premium when you're selling the option, when the volatility is extremely high, you will get a higher premium. And then when the volatility decreases, your premium will go down. So basically, for example, when I started selling a $90 strike put option right around when GME reaches $89. That means when the volatility is extremely high, let's just say I sold this option contract for $200. And then by the end of the market, when volatility contracts from, let's say, 200% to about like 100%, the innate value of the option actually decreases. So let's say you sold it for $200, and then by the end of the market, and it becomes $100 because of the volatility change, which is talking about like a couple of hours of trading. And because we're selling this option on the day of expiration, that also means that by the end of market close, if the stock closes above our option strike, that means we get to collect the whole $200 instead of just collect $100. So for example, right? So here's the trade that we placed this Friday on May 20th. So the bottom side of the trade is actually a more elaborate trade that I had with something else. But if you just want to just want to pay attention to the May 20th, the first two options. So what I did is, in the middle of the market, I sold one $90 put option, right, at $80, and then by the end of the market close, I collected the difference between $80 to $19. So I make $60 for every put option I sell. And then, for example, like in here, I rushly bought it back, like the $92.5 put. But I can, if you guys have more questions about this, you can ask me in Patreon chat or in Discord. I can explain it more detailedly. So essentially, what I did on Thursday is I sold a bunch of. This is just one of the account. I sold a bunch of puts at about like $100+, and I anticipate that by the end of Friday, GME's price is not going to be over $92.5. And then in the middle of the market, I realized the volatility is too high, so I used the other account to sell more put options and then start buying back my put options at a little bit higher price on this account, and then I hedged both accounts with a more sophisticated strategy. I can teach you guys if you guys have questions, just leave a comment down below. So essentially what you guys want to know is if you just pay attention to the top trade, this is like literally made in about like 2-hour time span. So basically it means every $9,000 you put out as collateral, you make $80, and by the market end, you will collect the entirety of the $80 premium. If you can time it really well, if you can make a high probability bet on whether GME is going to close below or above $92.5. In this case, in the middle of the market when volatility is super high, I'm actually really scared because I don't want to back hold GME at $92. And I really want to place a super safe trade. The whole point of this is we can make about $100 for every $9,000 in a very short time span. Okay, so if we take our trusty notebook out, so and again, like, we're not financial advisors, we do not get financial advisors, and everything we say on the channel is for shits and giggles, right? So let's just say we place those trades, and there are always going to be risk involved in any trades like this. Okay, so let's just say every Thursday we sell put at 12:30 or 11:45. If you guys want to know why we sell at these specific slots, you can ask questions, comment down below, or join our Discord and ask those questions. I might or might not make a detailed video on the timing in terms of how volatility works in the market. So for So basically, we get $120 for every $9,000. That's about 1.3% per week. It's actually 1.3% per 2 days. But we don't want to do the compounding for 2 days because we only trade, let's just say you guys are lazy, so we only trade the last 2 days of the market. So we take out our Excel sheet. We'll realize that on week 0, we put up with our principal $9,000 and we make 1.3% by using this strategy, and we get $117 in income. Okay. But what is interesting is if you compound that amount and then we do the exact same thing on the second week using the exact same $9,000, or in this case $9,117, you're making total $235. This might actually not look like it is a lot, but as you can see, as week goes by, week by week, week by week, week by week, so this is first month, this is the second month, and the third month. So every 3 months is a quarter. There are 4 quarters in a year. So if we use this strategy starting from the beginning of this quarter, which is the current quarter that we're in, we already make 16.7% on that $9,000. That means we made about $1,500 on that $9,000. Okay, and for those of you who want to see when we're gonna double our money, I can actually make this Excel sheet, public in Discord, so you can plug in a number and to play with it. As you can see, if we go and look at NASDAQ, this is 1 quarter. This is what this 1 quarter NASDAQ actually dropped down. But the thing is, our strategy actually, it doesn't matter if NASDAQ is going down as long as there's volatility, it works. So if we take our calculator and trying to calculate how much is NASDAQ, so this is what the entire market lost, right? So the entire market lost 14,200. Let's just do 14,200. 14,200. And then right now we're at 11,300. So minus 11,300 equals to 2,900 points. So the NASDAQ dropped about 2,900 points. Let's just say you invest in an index fund. So then you are down right now by about 20%. However, by implementing this strategy, you actually will be up by 16%. So if we actually do the math, compared to everybody else, you're actually up by about 36% compared to everybody else if you implement this strategy. Isn't that great? And again, we're not financial advisors. We do not give financial advices. So, and I've already showed you guys the results, right? Like you can actually do this with just $9,000 to start. And you guys are gonna ask me a question like, okay, what if I only have $1,000 to start? Of course, when you have $1,000 to start, you will make less money. But when the compounding effect takes over, it's actually really beneficial. Anyways, this is it for this video. Hope you guys love this content. If you like this content, smash the like button below, and also comment down below so the algorithm will recommend this to somebody else. And GME is one of those stocks that you guys really like. So this is just a strategy that you don't need to backhold GME, but you can make consistent return over and over again every single week by the end of this week. And when you enable same day option trading, you can actually just make these return numbers are basically 1.3% like every 2 hours or like every once a week for 2 hours. Essentially, you only need to trade for 2 hours a week, and then you can have similar results. And if you guys want similar trades like this, you're more than welcome to subscribe to our Patreon, and then we have a Patreon chat, and then in there you guys are, I have weekly Patreon Q&A sessions. If you guys have questions in there, I will really answer them very timely. And if you guys have any question regarding of this, leave a comment down below or just join our Discord. All right, see you guys on the upside.